Have you ever wondered how one man turned a textile company into a $700 billion empire? While everyone else was chasing the next hot stock, Warren Buffett was quietly building the most successful investment strategy in history. Today, I'm going to reveal the exact principles that transformed him from a paperboy in Omaha into the Oracle of Wall Street. And here's the kicker. These aren't complex formulas or insider secrets. They're simple strategies that anyone can use, but almost nobody does correctly. What I'm about to share with you goes against everything Wall Street wants you to believe. While brokers make millions convincing you to trade constantly, Buffett built his fortune doing the exact opposite. Stick around because by the end of this video, you'll understand why his approach is so powerful and how you can start applying these methods to your own investments, regardless of how much money you're starting with. Let me start with something that might shock you. Warren Buffett's most successful investments weren't made during bull markets or economic booms. They were made during times when everyone else was panicking. While other investors were selling in fear, Buffett was buying like his life depended on it. This isn't just contrarian thinking. It's the foundation of a wealth-building philosophy that has withstood every market crash, recession, and financial crisis of the past 6 decades. The first secret to Buffett's success is what I call the circle of competence principle. Buffett doesn't invest in every opportunity that comes his way. Instead, he focuses exclusively on businesses he thoroughly understands. When the dot-com bubble was inflating in the late 1990s, everyone criticized Buffett for missing out on technology stocks. They called him outdated, irrelevant, a relic of the past. But when that bubble burst and wiped out trillions in market value, Buffett's portfolio remained relatively unscathed because he stuck to what he knew. Here's what this means for you. Before you invest a single dollar in any company, ask yourself this question. Can I explain this business model to a 10-year-old? If you can't, then you're gambling, not investing. Buffett made his fortune investing in companies like Coca-Cola, which has one of the simplest business models in the world. They make a syrup, sell it to bottlers, and collect profits. That's it. No complicated algorithms, no disruptive technology, just a simple business that people understand and use every day. The second principle that separates Buffett from everyone else is his approach to market timing. Most investors try to predict when to buy and sell based on market movements. They watch charts, follow trends, and attempt to outsmart the market. Buffett does something completely different. He ignores the market entirely and focuses on the underlying value of businesses. His famous quote says it all. Our favorite holding period is forever. This long-term thinking is what allowed him to compound wealth at an astronomical rate. While other investors were buying and selling based on quarterly earnings reports, Buffett was holding stocks for decades, allowing compound interest to work its magic. Consider his investment in Coca-Cola. He bought the stock in 1988 and still holds it today, over 35 years later. That investment has returned more than 1,500%, but only because he had the patience to hold through multiple market cycles. But here's where it gets really interesting. Buffett doesn't just buy any stock and hold it forever. He follows a specific process for evaluating companies that I call the Buffett Checklist. First, he looks for businesses with economic moats, competitive advantages that protect them from competitors. These moats can be brand strength, like Coca-Cola's global recognition, or network effects, like American Express's payment processing system. Without a strong moat, any business can be undermined by competitors, making it a poor long-term investment. The third element of his strategy revolves around management quality. Buffett invests in companies led by honest, competent managers who treat shareholders as partners, not obstacles. He spends enormous amounts of time studying management teams, reading annual reports, and understanding how executives think about capital allocation. Poor management can destroy even the best business, while excellent management can create value from ordinary companies. Price discipline represents another crucial aspect of Buffett's approach. He never overpays for a stock, regardless of how much he loves the underlying business. His mentor, Benjamin Graham, taught him that price is what you pay, but value is what you get. This means waiting for the right price, sometimes for years, before making an investment. During the 2008 financial crisis, Buffett deployed billions of dollars because high-quality companies were trading at deep discounts to their intrinsic value. This brings us to one of the most counterintuitive aspects of Buffett's strategy. He gets excited when stock prices fall. While most investors panic during market downturns, Buffett sees them as opportunities to buy excellent companies at bargain prices. He famously said he tries to be fearful when others are greedy and greedy when others are fearful. This contrarian mindset requires emotional discipline that most people lack. The fourth principle involves understanding the difference between investing and speculating. Buffett defines investing as buying pieces of businesses, not betting on stock price movements. When he purchases shares in a company, he's literally buying a portion of that business and its future earnings. This perspective changes everything about how you approach the stock market. Instead of trying to predict short-term price movements, you focus on the long-term earning power of the underlying business. This business owner mentality extends to how Buffett thinks about dividends and share buybacks. He doesn't chase high dividend yields or get excited about share repurchase programs unless they make sense for the business. He prefers companies that reinvest earnings wisely to grow their intrinsic value rather than returning cash to shareholders through financial engineering. The fifth secret involves Buffett's information edge. Contrary to popular belief, Buffett doesn't have access to secret information or insider tips. His edge comes from reading more than anyone else and thinking longer term than his competitors. He reads annual reports, trade publications, and industry analyses voraciously. He spends most of his day reading and thinking rather than trading or analyzing charts. This dedication to continuous learning means Buffett understands businesses and industries better than most people who work in them. He can spot trends and opportunities that others miss because he has a deeper understanding of how businesses operate and what drives long-term value creation. This isn't about intelligence or connections. It's about putting in the work to understand what you're investing in. The sixth principle focuses on emotional control. Buffett has mastered the psychological aspects of investing that destroy most people's returns. He doesn't get caught up in market euphoria or panic during downturns. This emotional stability allows him to make rational decisions when everyone else is driven by fear or greed. He views market volatility as an opportunity rather than a threat. Most investors' biggest enemy isn't the market, it's their own emotions. They buy when they feel confident and sell when they feel scared, which is exactly backward. Buffett's ability to remain calm during market turmoil and maintain his long-term perspective has been crucial to his success. He doesn't check stock prices obsessively or react to daily market movements. The seventh element involves portfolio concentration. Unlike modern portfolio theory, which advocates broad diversification, Buffett concentrates his investments in his best ideas. He'd rather own pieces of 10 excellent companies than spread his money across hundreds of mediocre ones. This concentration requires deep conviction in your investments, which only comes from thorough research and understanding. This approach amplifies both risks and rewards, but Buffett mitigates the risk through his rigorous selection process. By only investing in companies he thoroughly understands, with strong competitive advantages and excellent management, he reduces the probability of permanent capital loss while maximizing the potential for wealth creation. The eighth principle centers on what Buffett calls the newspaper test. He only invests in companies whose business practices he'd be comfortable reading about on the front page of his local newspaper. This ethical framework isn't just about doing the right thing. It's about avoiding companies that might face regulatory problems or public relations disasters that could destroy shareholder value. Companies with questionable business practices or unethical management teams represent unnecessary risks that can be avoided through proper screening. Buffett's focus on ethical, well-managed companies has protected him from numerous corporate scandals that have destroyed other investors' wealth. The ninth secret involves understanding intrinsic value calculation. Buffett doesn't use complex mathematical models or rely on stock price momentum. Instead, he estimates what a business is worth based on its ability to generate cash flows over time. This requires understanding the business model, competitive position, and growth prospects. This fundamental analysis approach means Buffett can act independently of market sentiment. When he believes a stock is trading below its intrinsic value, he buys regardless of whether the market agrees. This independence from market opinion has allowed him to make some of his most profitable investments during times when popular sentiment was negative. The 10th and final principle involves patience and discipline. Buffett waits for the right opportunities rather than forcing investments. He's willing to hold cash for years until he finds companies meeting his criteria at attractive prices. This patience is perhaps the most difficult aspect of his strategy for most investors to implement. In today's instant gratification culture, waiting years for the right investment opportunity feels impossible. But Buffett understands that great opportunities are rare and worth waiting for. His best investments often came after long periods of patient waiting, followed by decisive action when the right opportunity presented itself. Now, you might be wondering how to implement these strategies with a smaller portfolio. The beautiful thing about Buffett's approach is that it scales. Whether you're investing hundreds or millions, the principles remain the same. Start by building your circle of competence around industries you understand. Focus on quality companies with strong competitive advantages. Buy when prices are attractive and hold for the long term. Remember, Buffett didn't become wealthy overnight. His fortune was built over decades through consistent application of these principles. The key is starting now and staying disciplined. Every legendary investor started with their first investment, and these principles work regardless of your starting point. The most important takeaway is this. Investing like Buffett isn't about complex strategies or insider knowledge. It's about developing the right mindset, doing thorough research, and having the patience to let compound interest work its magic. While everyone else is chasing the next hot stock or trying to time the market, you can build lasting wealth by following the principles that have worked for the greatest investor of all time.